The US obviously has a very large, borrowing. I think estimated around 30 trillion, more than 30 trillion dollars. And for a country which is developed, it's also, by the way, adding to that debt quite rapidly.
But what happened over the last year, like the year ending FY23, is that their fiscal deficit came out to be $2 trillion, when its first estimate, made in May 22, was only $1 trillion. In China, what they did, they gave a lot of debt. So it was, in a way, socialized losses and privatized gains. So what they did was gave very low interest rates to savers, 2%, lent money at very low cost of capital to a lot of companies. The companies that succeeded, as we discussed on leverage, if it works beautifully. So in very short space of time, they had hundreds of billionaires.
Right.
But if the loan doesn't work, then the losses are absorbed by the banks and in a way by depositors. The problem I think they are also into is that this is, contrary to theory, a pro-cyclical fiscal deficit.
Hello, and welcome to another episode of Open Dialogue by Axis Bank. Continuing last week's discussion, we chat about debt in the global context. In this episode, we will look at how various countries have looked at their own debt positions and what it implies for them as well as for the global economy. Join me in this conversation with Dilkan Mishra. Move a little bit to cover the rest of the world as well. Let's start with the US. The US obviously has a very large, borrowing. I think estimated around 30 trillion, more than 30 trillion dollars. And for a country which is developed, it's also, by the way, adding to that debt quite rapidly. So two questions: one, what's happening, and B, is US a special case given that, like, don't laws of economics apply to them, given that they are the reserve currency of the world, or is it something else happening?
See, the US, after 2008-9, I think in one of our earlier episodes we have discussed this, they had adopted a tight fiscal, loose monetary approach, right? So you can manage economic cycles by reducing interest rates if you're in a downturn, or increasing fiscal spending. So what they decided, because they had spent, they had used a lot of their tax dollars to recapitalize banks in 2008-9, they decided to tighten fiscally and have very easy monetary conditions. But they realized that it didn't work, or it worked too slowly. So it took 7.5 years for unemployment to normalize and all that. So this time they've gone into a loose fiscal, tight monetary approach. So they've raised interest rates, they're doing quantitative tightening, and they're keeping the fiscal deficit elevated. Now, their intent was to give a large fiscal stimulus, which is what they gave in 2021, and then quickly bring it down. But what happened over the last year, like the year ending FY23, is that their fiscal deficit came out to be $2 trillion, when its first estimate, made in May 22, was only $1 trillion.
Right.
So there was nearly a $1 trillion, which is 3.7% of GDP, increase in the fiscal deficit of the US in just 1 year. So the total fiscal deficit was 7.5%. And debt held by the public, total debt to GDP for the federal government is about 110%. The debt held by the public is about 100%. 10% is held by the US Federal Reserve, 10% of GDP. And so this 100%, if you use that debt to GDP math that I was earlier talking about, if your deficit ratio is 7.5%, your denominator needs to grow at 7.5% as well. In an economy which is supposed to grow at 2% in real terms, that means 5.5% inflation. Now, that's also unacceptable, which means that over the next decade, this ratio will keep going up. The problem I think they're also into is that this is, contrary to theory, a pro-cyclical fiscal deficit.
Right.
So as we discussed earlier, fiscal deficits are used by governments to manage economic cycles. that if there is a downturn, then you increase the fiscal deficit. This government has been having a 7.5% of GDP fiscal deficit with unemployment at a record low of 3.5%. So if the economy goes into a downturn and a recession, and recessions are quite common over 5-7 years, then your fiscal deficit will expand even more. And there your denominator doesn't grow, so the debt to GDP starts to grow up even faster. So they are clearly on an unsustainable debt path. Right? So at some point they will have to get into what we discussed earlier, which is financial repression. Basically using the power of the state, the fact that they can define the laws, the rules, they can print money. They will force a lot of losses over a period of time through high inflation on a number of savers. So the US is, I think, in a particularly precarious condition. Why is it that they're not seeing a run, right? So given that the Congressional Budget Office, which does the 10-year projections, is showing that the debt to GDP will be 125.
Right.
And if you build in last year's slippage, it will be 150.
Right.
If you build in 1 or 2 recessions in there, it will be like 180. That level of debt to GDP is unsustainable. So why are people not running away from your sovereign debt? This is where the fungibility of money, the fact that money is a myth, all of the things we have discussed earlier comes into play. You see, the world needs safe assets.
Right.
And there's not enough gold for in the world to manage that, right? So the world needs a lot of safe assets. And what are safe assets? Safe assets are assets that everyone thinks are safe. And there is a very nasty equilibrium there, which if it breaks, it will be very dangerous for
Correct.
all. But so long as people believe that it is safe, it will be safe. And as the economies grow, the demand for safe assets keeps growing. And whether we like it or not, the US Treasury, the 10-year bond or whatever, the 30-year bond, is considered a safe asset. So which is why there is a very natural structural demand for it. So as the economies grow, the insurance funds, the pension funds, and as they build in their global books, they end up buying some part of that. Central banks would keep buying them. But my sense is that as the world wakes up to the reality that without financial repression, the US will not be able to service this debt, I think we will see a lot of turbulence. But that's some time away.
Right. So this is just going back to our history of debt conversation. This is a case where, as an example, the largest holdings of US treasuries are Japan, China,
Saudi Arabia,
maybe to some extent India as well.
Correct.
And particularly if you think of China, India, these are poorer countries. And so here the poor country is financing.
Yeah.
So it's actually the reverse of what.
No. It's no different from us demanding a poor person be using deodorant and use starched clothes and iron clothes when just to be accepted in a setting where he or she can earn money.
Right.
So it's a very bad example, but
Yeah.
it is an appropriate one here, because in order to signal to the world that you are safe, you need to accumulate US dollars.
Yeah. Absolutely. Great. So we move on. Just like we spoke about the US, also the other interesting country at this point in time is China, which seems to have its own debt type of issues. And so, again, helpful, Nilkan, to get your perspective on what has happened in China. How did this debt buildup happen, and what's happening right now, and what could.
So the first thing is that the sovereign in China, the federal government, their debt to GDP is not very high.
Right.
But that's also, at least at first glance.
Right.
And the reason for that is that it's a very different government structure. So the barriers between, or the boundaries between where the government ends and the private sector starts, or rather the corporate sector starts, are very diffuse. They're not very clear as they are in India or any other country. So, for example, a lot of the calibration of how much credit is in the system, how much money in the system is done through Chinese sovereign banks, SOE banks, state-owned enterprise banks. Now, it is understood that those banks will not fail because the state will come and protect them. But like in India, if the government issues a bond, and so a bank will not give a loan to someone just because the government is asking them to. And so if the government wants a loan to be given, they have to give it themselves and then borrow it from the bank, right? In China's case, they can just tell the bank to do it, right? And so therefore, the debt to GDP at a central level is understated. In China, there are two big issues. The first is at the local government level, which is the local government financing vehicles. So what happened after 2008-9, around 2008-9, was when, remember, China's current account surplus was 10% of GDP.
Yep.
Right? And so it was an economy which, in 2001 and since they joined the WTO to 2008, had been growing on the basis of exports. Now they found that the US was getting into a very big recession and there was going to be a sustained downturn. So what did they do? And so they decided to build a lot of infrastructure. Now, you cannot control. It's also a very large and complex economy. There's a lot of regional variation and all that. So what they did was they gave a lot of freedom to the provincial governments to build infrastructure. So these were financed through local government financing vehicles. And so a lot of the debt, in fact, there are estimates that I just read a paper that some Chinese scholars have found that this debt is actually 50% higher than what IMF had estimated. So just local government financing vehicles
Okay.
Actually have 90% or 88 or 90% of GDP worth of debt. Just the local government financing vehicle, local governments. Now, as we discussed earlier, some of this has been used to build infrastructure which is unsustainable or is perhaps not worth having. So what happens in this case is that while you are building that bridge to nowhere or that visa or immigration center which no one goes to, the building of that creates demand for steel, cement, labor and all that. And so that adds to GDP. But once it is built, then someone has to, if it is not productive, someone has to bear the loss.
Correct.
And so the problem by itself is not a high debt to GDP ratio. The problem is that that debt has been taken to build assets which have to be junked. And therefore, some saver has to take a loss.
Yep.
Now, how do you play this? And that's where the uncertainty is. And this is where, when you have such a high debt to GDP ratio, it is usually resolved not by a very cataclysmic fall, which I don't think is likely in China as well, but over a sustained period of low growth, because the saver is not sure the money is coming. The reason why GDP was sustained was building these bridges to nowhere, which of course cannot be sustained. And therefore, economic growth then falls from 4-5% to 2%. The second big issue in China, and which again is something that I think is starting to get challenged, is actually there's another issue which I come to, but is that when you are starting from a low per capita wealth, it is very difficult to find equity capital. Right? So as you know, there are two types of capital: there's debt capital and the equity capital. Equity capital has good shock absorptive capacities, meaning that if there's a loss in the company, you don't get anything.
Correct.
Company goes under, you lose everything.
Correct.
In debt, you are giving a guarantee that every year I will get whatever X% interest. Now, in a low per capita wealth economy, the amount of equity capital is constrained, is limited. Right? Most people are not confident enough to risk their savings into equity capital. Now, which is part of the reason why countries struggle to get out of this low wealth trap, and this is a 200-year or 100-year process, which is what happened in the developed world. In China, what they did was they gave a lot of debt. So it was, in a way, socialized losses and privatized gains. So what they did was they gave very low interest rates to savers, 2%. They lent money at very low cost of capital to a lot of companies. The companies that succeeded, as we discussed on leverage, if it works beautifully. In very short space of time, they had hundreds of billionaires.
Right.
But if the loan doesn't work, then the losses are absorbed by the banks and in a way by depositors. So that is the model that they have adopted of socialized losses and privatized gains. And that is another reason why I think debt to GDP is high. The third reason why debt to GDP is high is because of real estate. So that's where mortgages as a percentage of GDP are elevated. Compared to what's there in US and rest of the developed world, that ratio is still low. But that is another reason why the Chinese economy is a bit risky at this stage, because there are several $1 trillion of payments made by home buyers to developers, and the developers run out of money, so they can't finish those houses. So this is another debt which potentially cannot be serviced, and that is, and then on the home buyers themselves would have taken mortgages. So there are several factors in China. Which are the problems? The debt to GDP ratio by itself may not be a big factor.
Right. So moving on now, there are countries which have faced debt crises. You mentioned many of these: Greece a few years back, Argentina, Russia, Southeast Asian countries, etc. Sri Lanka, Pakistan. So just talk us through what happens. Like you explained how the debt build-up happened and how they came to a certain level. But then also there is a process that happens once the crisis hits and, let's say the country comes back to normalcy. So what is that process and how does it look like? What happens in that?
So let's take a country which, let's take Sri Lanka, right? So they built these giant port, a lot of highways, and the necessary revenue didn't come through. And there were other accidents and other bad policies, and of course the civil war and lots of other things which their potentials, the primary source of income was tourism, that didn't happen.
And COVID
hit it and all that. So and then that ill-advised move to organic tea farming and all that. And so all of those things happened. Now, as a result, when it came to make the payment, because see, the funding that came for the port or the highways was in the form of debt.
Right.
Now, if it was a productive port, it would have generated the income which could have been used to service the debt, but it didn't. And in which case, then how do you find now? So there can be fungibility. So if the government had taken that up, government could have used other tax dollars to service it. But at a country level, the dollars that they were seeing as inflows were far in deficit compared to the dollars that they needed to service these debts. Not just the interest cost, but also the principal repayment. So when something like this happens, you then go out and seek recourse from, say, the International Monetary Fund or the World Bank and say that, look, we need a bridge loan. Now, when these organizations then give these bridge loans so that you don't default on any debt, they also demand that how are you going to make it sustainable? So how are you going to find these dollars? And usually that requires significant restructuring of the economy. So what that usually means is that your currency devalues massively, in which case all the imports become expensive. So like if you travel in Sri Lanka, you will realize that fuel costs have just spiraled up, right? And so people are struggling to drive cars. The subsidy levels are brought down. 75% of Sri Lankan government expenditure is committed, right? Salaries, pensions, interest, and all that. There's nothing else to do. Occasionally, it can mean that you force people to take write-downs on their defined pension schemes. So there are some very tough measures that to be undertaken. In a way, you can think about this as an organism that grew too big and then has to be brought down to size. What used to happen in Greece very famously, that people would retire at 53, 54 and then draw pensions for 30 years after that, and very comfortable lives. There was significant tax evasion. and people were just not contributing to the sovereign. So there was a very forced curtailment of government salaries, like what's happening in China as well now. And it's not to default, but as the local governments are running out of funds, they are slashing the bonuses of government servants, and that's also driving consumption down. So the whole process is that you keep, so suppose you kept taking on debt, you kept building things, suddenly then the project gets over, or the projects get over, and you realize the income is not coming through. And so effectively you have to go back to the earlier level. And so there is a very painful process of downward adjustment to incomes. Some of it could be by the devaluation of the currency, in which case your ability to buy what is international drops, falls down. And so you go through a painful multi-year process of, and human brains are remarkably adaptable. So in 2-3 years, the people's consumption, expectation of what is a good quality of life, and so on and so forth. And if these policies are implemented wisely, then the economy, like Greece is one of the strongest economies in Europe now, right? So if you implement some of these reforms wisely, you shed the flab, you don't cut the productive assets, the politics of this process is managed well, then the economy can start rebounding very quickly as well.
Right. Great. So in this case, it's a painful process, which I guess impacts again a lot of the common folks, right? The common taxpayers and savers and so on and so forth. But it's almost like, I mean, to use another analogy, somebody who's grown very fat and now has to shed a lot of weight so that can become more healthier, more productive,
correct.
And then can continue to do better. Fantastic. So now in the context of all this, Nilkant, one final question on the national side, which is, if you take all of this into consideration and you look at the fact that India is rated BBB minus, which is the lowest rung of investment grade across rating agencies, right? And the US is, like, even after the downgrades, it's AA plus, and China is E minus, I think, if I'm not mistaken. So what explains this?
I have my personal opinion. A simple answer is bias,
right.
but I'm sure the rating agencies will have a different opinion. If I was to put myself in their shoes, I actually honestly struggle to understand this. So
even in their shoes,
yeah. But I would say that, look, the debt to GDP is high.
Yeah.
So at 82%, the vulnerability or the risk that you go into one recession, suddenly it's at 90%,
right.
And then you very quickly get into a debt spiral, is very high. So that's something that I think needs to be kept in mind. Second, the politics in India, and especially if you see a large number of states getting into, so as we discussed earlier, at a state level, because the deficits are capped, it's always a quality of expenditure problem, never a quantity of expenditure problem. But the risk that if, say, some of these parties were to start implementing these schemes at the central level and become very fiscally profligate, then very quickly your debt to GDP can just go through the roof. If the political platform or the political slogan is redistribution, and that guaranteeing a certain amount of funds per month and free this and free that, free electricity and free bus rides and all of that, is the way to win power, then at least at a fiscal level, sustainability becomes a big issue. So while I think that given our rising tax to GDP ratio and our sticking to the commitment of the fiscal consolidation path, as well as very healthy underlying trends in GDP, right? That our nominal GDP growth is going to be in double digits for at least the next 3 to 5 years, makes us, at least incrementally, our fiscal situation will improve, not worsen, is something that I feel quite comfortable about. If I try really hard, perhaps I can see some perspective in keeping our rating so low. But to be honest, I mean, at a similar, and if you think of India as an emerging market with a fragile politics and all that, compared to other countries that are emerging markets, our debt to GDP is high.
Right.
The reason why I think it is less of a risk is because all of it is domestically funded. So the risk of default is very low. The risk of financial repression to pay it off is reasonable, but perhaps if you use a very simple comparison of Brazil is at a much lower level, or Mexico is at a much lower level, and all the emerging markets are much lower levels of debt to GDP, then why should India be at 80%? And therefore, we'll keep India at a lower rating. Perhaps that's the logic being used, but honestly, I don't think still that makes sense.
Fantastic. Great. Thanks a lot for that conversation, Nilkant. We discussed a range of topics. So starting with a very interesting historical perspective on debt and how debt actually is a great tool to ensure productive deployment of resources so that the economy as a whole can benefit.
Okay.
And so debt, when used in the right amount, can be a very powerful tool.
Yes.
When debt becomes unsustainable is when it becomes a huge problem, because debt increases risk, and risk benefits on the upside, and it benefits more on the upside, and similarly it hurts more on the downside. And so the amount of debt and ensuring that it is sustainable is something that needs to be kept into consideration. The second aspect we discussed was the quality of the spends, like what you use for the debt for is equally important. If you are able to borrow so that you can generate more and use it more productivity, it helps the economy, so it's positive. So that's another thing we spoke about. We spoke about India and how India's debt to GDP has moved. Also, we spoke about two topical topics. One is OPS versus NPS, and how that kind of is now a reasonably large contributor to what happens to the deficit. And we also spoke about the situation in the US and China, both of who seem to be a little bit kind of in that getting to unsustainable levels, which means that there are likely challenges coming in the future. A great conversation, Nilkant. Thanks a lot.
Thank you again. Lovely catching up
for the chat.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.